Doing your own due diligence is so important. We have to presume that this year's bear market would have taught you this by now. And in our last two videos, we've covered the financial chaos in the UK and suggested that something just didn't feel right. We recommend checking them out. But if you'd listened to the commentariat, you'd be right to believe that the UK lowering its top rating tax blew up its government bond market and obliterated sterling. Some, like the eminent Larry Summers, even went so far as to claim that lowering taxes in the UK might instigate a global meltdown. Who knew the UK was so influential? And yet a few days later, we know what happened and the silence of the mob is deafening. Long story short, the pension industry is tricky. People are living longer, QE has collapsed the government bond yields, and legacy-defined benefit schemes that pay out a fixed amount irrespective of market performance are a huge insolvency risk for their parent companies. To get around this, pension funds use vehicles like liability-driven investments, by where they use swaps on government bonds in order to get exposure to riskier, higher-yielding assets that they usually can't invest in because of their risk profiles. The aim is to use these leveraged derivatives to close the funding gap, but when they don't manage their risk properly, especially in a bear market with rising interest rates, that's where problems start. So what happened on Friday was that heavily leveraged pension funds got margin called on risky investments and had to quickly sell UK government bonds, which caused panic and saw the pound get clobbered. And yesterday, the Bank of England had to step in with £1 billion worth of reserves to settle down the market. Now, narratives drive price action, but a week down the line, we have a fuller picture of what happened. And yes, the fallout may continue to be bearish, but we still feel a medium-term reversal for cable to $1.20 is a good risk reward.